Hello and welcome back to your South King County Real Estate Update. My name is Sarah Eggleston with Stone Egg Realty at John L. Scott, and I'm here to deliver your weekly real estate news for South King County. I'll go ahead and jump into the slides. So today is July 22nd, 2022. And I do have Seahawks schedules. I've mentioned that a couple times before, so make sure you get your name on the list. I'm going to be mailing those out in the next week or two. If you would like one, please let me know how to get it to you. Let's find out what happened this week. So today is a very exciting day. I get to deliver keys to a buyer, and I am so excited. I've been working with this couple on and off for a couple of years. They'd shop around for 3 months and then renew their lease and then come back in 9 months later. And we did this a few times, but their landlord was going to be raising their rent significantly this time. So they were a little more motivated and really put their best foot forward when making their offers. It was at the beginning, we went pending kind of the beginning of the softening of the market. So we were able to, secure the home. Even though it was multiple offers, it wasn't much over list, and we were able to have a very, very smooth closing. So this is a very exciting day for me and for my clients. Go ahead and jump into the slides because we have a lot to get through today. Housing market chills as mortgage rates prices scare buyers. So this whole article is a lot more doom and gloom than I would like to admit. Interest rates have been rising pretty significantly. They've gone up so much since the beginning of the year. This week, they're at 5.54. A year ago, it was 2.78. So this is a huge difference, and it certainly has affected the demand in the market and what's happening overall. All signs are pointing towards the Fed raising rates again when they meet next. So that is definitely something that will continue to affect mortgage rates and the housing market and so on. In Seattle, a hotter housing market than the previous example that they mentioned in this article, which is linked below. So if you're curious about this, make sure to go read the whole article because it is a lot longer than I'm covering here. But in Seattle, a hotter housing market, a $2,000 a month payment this time last year would have gotten a buyer a modest 1,300 square foot home. That sort of payment would get them only a 950 square foot apartment now. So this is in Seattle, which has higher prices than the surrounding areas, with a few exceptions. There's been a lot of people purchasing to own a home that no longer qualified for the loan that they'd applied for because of the rising interest rates. It no longer worked out with their personal stats. But there's been a lot of investors that have been backing out of deals as well. People that have bought land that they were going to build on that have backed out of those deals or those sorts of things. But there's been a lot of investors that have backed out. Builders are pulling back on building, which is with our shortage of housing is not something that we want to see, but it's something that we are seeing because their return on investment isn't going to be as great going forward. We have had really low interest rates for more than a decade. Historically, we are pretty much at the historical average right now at 5.5-ish. For the past decade or so, interest rates have been significantly lower. And so it is a big difference from what a lot of people have experienced. Black Knight is estimating that a typical borrower's monthly payment has increased by 44% since the beginning of the year, just based on the rising interest rates, rising prices, and more than doubled since the start of the pandemic. Unfortunately, this is being felt the most at the bottom half of the market. Lower price points, the first-time buyers, those types of people, this is where we're seeing the most pullback on purchases. The most people drop out of the market, most canceled listings is in the lower price points, just because these people were so on the edge of being able to buy a place anyway, that now that interest rates have risen, it kind of pushes them out. For those that can still afford to buy a home with the higher interest rates, there is a silver lining more options, like lots more options, and fewer bidding wars. Homes aren't getting bid up as high over the list price because you might be the only offer coming in. So there are a lot of creative financing opportunities out there. I know the adjustable rate mortgage got a bad rap in 2007, 2008, but we do expect interest rates to head down over the next couple of years. So like a 5-year, 7-year ARM, you'll probably refinance and get out of that loan before before that locked in rate period ends. And there are so many more options. I'm actually getting a class ready for next month of the creative buyer solutions in this environment. So it's a class dedicated to you buyers out there that has some really strategic options for financing, for getting your offer accepted. We are seeing a lot more offers accepted with inspection contingencies, finance contingencies. Like, people no longer have to waive everything to buy a house. So there is a lot of opportunity out there, and a lot of opportunity to get a creative financing product together that will allow for lower payments for a couple years and then refinance. So stay tuned for more information about that class. This article, I predicted that we would see this article a year ago, probably. I knew that when they ended the foreclosure moratorium, whenever that was going to be, we were going to start to see foreclosures have increased a lot. But that's because there was a moratorium on them and they couldn't do foreclosures. So it has been anticipated for quite a while. And despite the fact that we were up 219% from the first half of last year and up 19% from the first half of 2020, 2020 is when those moratoriums went into place and people couldn't be foreclosed on for a long period of time. So up 219% is not that surprising. And if we look at the chart, so we know that there was a lot of foreclosures in 2008, 9, 10, 11. So this is the chart for those foreclosures. And we have been historically low on foreclosures leading into the pandemic. 2021, of course, there was moratoriums on foreclosures pretty much the whole year. And those have been released and we have foreclosures again. A lot of the foreclosures that we are seeing today are on loans that would have been foreclosed on within the last 2 years. So without having the ability to foreclose on people, those were postponed and those are now happening. We're expected to see an increase of foreclosures heading forward as well, but we're still historically low. This is an article that I was wanting to cover last week, but didn't have time. But this is super important, and I think it's really interesting. So I'm going to dive into this one a little bit. How the next U.S. recession may look: long, moderate, painful. So recessions, they all kind of look different. They have different causes, different outcomes, and different intensities and lengths. So there's been a lot of the recessions in the last couple decades that have been about 10 months. They're expecting this one to be a little bit longer. However, not as intense as 2007 to 2009 or the 1980s when the inflation was last this high. Good news, there is a limit to how severe it's going to be. The bad news is it's going to be prolonged, and that's from a senior U.S. economist. So there are many signs of economic weakness, but the Fed Chair Jerome Powell really is saying, hey, we can tame inflation without causing a recession, but a growing number of private economists aren't convinced. Here's another quote for you. A faltering economy is all but inevitable. The question has moved beyond if we are going to see a recession to the depth and duration of a downturn. So a lot of economists out there are coming to the conclusion that we are going to see a recession of some sort. It's not going to be as severe as some of the previous ones, but it might be longer. So for the housing market, housing has been battered by the late Fed engineered surge in mortgage rates, which is completely true. We have had as the last article mentioned, a decrease in demand based on affordability and those mortgage rates. but we are in a way better place than we were in 2006, 2007, when we were in a speculative building boom. Today, we are about 2 million housing units short of what we would like to see for our demographic in the US. So that is going to provide some sort of insulation for the housing market and not see those price decreases. We will see a sharp decline in home appreciation, but probably not an outright decline for year-over-year numbers. In the labor market, there has been a shortage of workers. There's been people that have had signs out now hiring at a lot of places. There's been people that have been begging for employees. So hopefully that means that they won't lay off the current employees that they do have leading into the recession. If they're already understaffed, then I don't think that we will see as many layoffs as we have in some previous recessions. But recession does not equal a housing crisis. The home price change during the last 6 recessions, there's only 2 of those 6 recessions where home prices decreased, and only one where it decreased significantly. And that's because the housing market, the mortgage lending market caused it. Beyond that, we generally see homes appreciate. Throughout history, during a recessionary period, interest rates go up at the beginning of the recession, but in order to come out of the recession, interest rates are lowered to stimulate the economy moving forward. Historically, we have seen a repeated uptick in interest rates followed by lower interest rates. And here is a graph and chart outlining those recessions highlighted in yellow. We start out heading up, and then the interest rates drop to come out of the recession. And that's something we've seen repeatedly. Home price appreciation versus inflation rate. Every decade, other than the 1980s, which was just a hair, and the 2000s, the home prices appreciate greater than the inflation rate. So real estate is a great way to hedge against inflation. And we do, as I said before, expect home prices to continue to increase, just at a way less significant rate. So we're looking at ending the year around 9%, according to this forecast for December to December year over year. And then heading forward between 3 and just over 4% for the next few years. And that brings us to our market stat minute. We did tick down slightly in new listings this week at 1,042. For King County, pending listings is 816 and 661 sold. For our local area breakouts, this shows the difference in markets across our region. So Brenton, we actually have fewer new listings than pendings. Everywhere else, we have more new listings than pendings, but Kent and Federal Way are a little bit more extreme on that. Auburn is a little bit more closer margin on that spread. Last week, we had a 5.51% interest rate for our weekly average, and we're staying pretty steady this week at 5.54, ticking up just ever so slightly. And for our daily interest rate, we are at 5.5%. So we have come down a little bit this week from where we started the week at. And just a reminder, I do have summer buyer and seller guides available. So if you're considering a move this year, please let me know. I'd be happy to send one of these to you. They've got some really great information about the market right now. So definitely reach out about that. And again, reminder, if you would like a Seahawks schedule, let me know how I can get it to you. Thank you so much for joining me. If you have any questions, please feel free to reach out. My phone number and email address are on the screen there. I would love to have a conversation about the real estate market in your area or an area you're interested in moving to. Let's just set up a time and have that conversation. So thank you so much for joining me for your South King County real estate update. I'll be back here next Friday at 3 p.m. and have a fantastic week. I'll see you next Friday.